The funding rate in cryptocurrency refers to periodic payments made between traders in a futures market. It ensures that the price of a perpetual futures contract stays close to the actual spot price of the underlying asset, such as Bitcoin or Ethereum. This mechanism is unique to perpetual futures contracts, which don't have an expiration date. How does the funding rate work? In perpetual futures, traders can hold either long positions, betting the price will rise, or short positions, betting the price will fall. The funding rate is used to incentivize balance between these two sides of the market. Positive funding rate. If the futures price is higher than the spot price, traders with long positions pay the funding rate to traders with short positions. This discourages excessive long positions and helps align the futures price with the spot price. Negative funding rate. If the futures price is lower than the spot price, traders with short positions pay the funding rate to traders with long positions. This discourages excessive short positions and brings the futures price closer to the spot price. Why is the funding rate important? Keeps prices aligned. The funding rate ensures that futures contracts don't deviate too far from the underlying spot price. Affects trader profits. If you're holding a position in a futures contract, the funding rate can either cost you money or pay you money, depending on the market sentiment. Market sentiment indicator. The funding rate reflects whether the market is leaning bullish, positive rate, or bearish, negative rate. Example of funding rate. Let's say you hold a long position in a Bitcoin perpetual futures contract. The funding rate is 0.01% every 8 hours and is positive. If you hold a $10,000 position, you'll pay $1 every 8 hours to traders with short positions. If the funding rate is negative, you would instead receive $1 from short traders. How is the funding rate calculated? The funding rate is typically based on interest rate, a base rate, often fixed. Premium index, the difference between the futures price and the spot price. Exchanges calculate and adjust the funding rate at regular intervals, such as every 8 hours. Benefits of understanding the funding rate. Optimize profits. Traders can adjust their strategies based on the funding rate, potentially earning money through payments. Manage costs. Long-term position holders must account for funding payments, which can accumulate over time. Gauge market sentiment. A consistently positive or negative funding rate indicates market trends, helping traders make informed decisions. Risks of the funding rate. Unpredictable costs. Rapid market changes can flip the funding rate, turning what seems like a profitable position into a costly one. Increased leverage risk. High leverage amplifies the impact of funding rate payments, potentially eroding profits or increasing losses. For crypto traders in perpetual futures markets, the funding rate is a key factor that can affect profitability and strategy. Keeping an eye on it can make the difference between a winning and losing trade.